Hello my intelligent friends, welcome to this fourth lecture on the topic of admission of a partner. This is the last lecture on theory basis or on the theory part of the topic of admission of partner. From next lecture I am going to talk about the practical problems. So I will be solving around 13 to 14 practical problems. One problem per lecture, that's what I am going to solve. The first lecture in this series was talking about the steps to be followed for accounting of admission of a partner, and we have seen that there are 7 steps. First step was open necessary ledger accounts. Second was transfer of assets and liabilities from the existing balance sheet. The third one was capital brought in by the new partner. Next one was treatment of goodwill. Thereafter it is adjustment of revaluation, fifth step. Sixth step was closing revaluation account, finding out profit or loss, and transfer it to old partner's capital or current account in their old profit sharing ratio. And the last step was closing all other sundry accounts and transferring them to the closing balance sheet. The closing balance sheet should tally. This is what we have already studied. In that, the fourth step was talking about treatment of goodwill. And when it comes to treatment of goodwill, we have considered there are 3 points in the same. The first point was what is the value, second point was what is the ratio, and third point was what are the entries to be passed for accounting for goodwill. Value can be either firm's goodwill or it can be new partner's share. Ratio can be either sacrifice ratio or old ratio or new ratio. How to calculate sacrifice ratio, how to calculate new ratio under various situations we have already seen in the previous lecture. How to determine the value of goodwill, let it be firm's goodwill or new partner share. We have discussed it under average profit method or super profit method in second lecture. And now is the last lecture, that is accounting entries for goodwill. So value, firm's value or new partner share. Ratio, either old ratio or new ratio or sacrifice ratio. These things are already known to us. Now let us understand how to use two different things, value and the ratios, and ultimately create the accounting entry from the same. For that purpose, we can specify that the treatment of goodwill can be considered in basically two different ways. Number one, when new partner is bringing his share of goodwill in cash, then I call it as premium method. On the other hand, when the new partner is not bringing his share of goodwill in cash, in that case I call it as valuation method. So first one is new partner bringing his share of goodwill in cash, I'll call it as premium method. Second one, new partner is not bringing his share of goodwill in cash, we will call it as valuation method. Let us now try to understand how the premium method is required to be accounted or how the valuation method will be accounted by us. The first thing, when you are looking at the problem of admission of a partner and you are given the old balance sheet, that is a problem balance sheet, the first thing you should check is goodwill already appearing in the balance sheet or not? So look into the balance sheet first. In the balance sheet, is the goodwill already appearing there or not? This is the first point. If goodwill is not appearing in the balance sheet but there is an adjustment, then we are going to use this pink table. I am repeating again, goodwill is not appearing in the balance sheet. So existing balance sheet, problem balance sheet. On the asset side there is no goodwill. On the asset side there is no goodwill, but in the adjustment something is mentioned about goodwill. Then what can be mentioned about goodwill? There are 3 different things which can be mentioned about goodwill in such a situation. First one, goodwill is not appearing in the balance sheet. So old balance sheet, problem balance sheet, asset side, there may be many items: land, building, plant, machinery, furniture, stock, debtors, cash, bank, vehicles, investments, anything. But there is no goodwill in the existing balance sheet. But although there is no goodwill in the existing balance sheet, if the adjustment is having some or other type of clarification, some or other type of transaction about goodwill, then we are going to use this chart. Now what kind of adjustment may be there? There is no guarantee that every problem will have only one adjustment. Different problems may have different adjustments. So let us consider what are the varieties of adjustment may come. So although goodwill is not appearing in the balance sheet, following varieties are possible. First variety, new partner is bringing his share of goodwill in cash and it is retained in the business. I'm repeating again, new partner is bringing his share of goodwill in cash and it is retained in the business. Now we have already discussed in the previous slide that if the new partner is bringing his share of goodwill in cash, it is called as premium method. So the name of the method is going to be premium method. So which method we are going to follow? Premium method, because goodwill is not appearing in the existing balance sheet and the new partner is bringing his share of goodwill in cash. After he bringing goodwill in cash, we are maintaining it in business. We are going to retain it in the business. Then what is to be done? Then this method is called as premium method. The value of this method, when we are going to pass the accounting entry, which value we are going to consider? We are going to consider new partner's share in firm's goodwill. So if the adjustment is already telling you that Mr. X is a new partner and he is bringing rupees 15,000 as goodwill in cash, or is bringing 20,000 rupees as goodwill in cash, or is bringing rupees 30,000 towards goodwill or his share of goodwill. So in that case you can specify we already wanted only new partner's share in firm's goodwill, and the problem is already telling us what is the amount of goodwill which he is bringing in. So whatever we wanted, that's the same thing is already given. We can use the amount given in the adjustment for the purpose of passing the entry. Sometimes the problem may specify that new partner brings his share of goodwill in cash and for that purpose firm's goodwill is valued at rupees so and so, or firm's goodwill is calculated by average profit method, or firm's goodwill is calculated by using super profit method. So one thing they are clear, that new partner is bringing his share of goodwill in cash, but how much he is bringing in cash, that amount they are not ready to tell. Instead they are telling you for this purpose the firm's goodwill is valued so and so. Then we should be careful, because the goodwill is not appearing in existing balance sheet. Further, the adjustment is telling that new partner is bringing his share of goodwill in cash, and the problem is not telling us what is the amount which is brought by him in cash. Instead the problem is telling us what is the value of firm's goodwill. Then we should convert the given amount of firm's goodwill into new partner's share. If new partner is given half share in the profits, then firm's goodwill into half. If new partner is given 1/4 share in the firm's profit, then firm's goodwill into 1/4. If new partner is given 1/10 share in firm's profit, then firm's goodwill into 1/10. That will be the value to be considered here. So I'm repeating again, under premium method we should not consider firm's goodwill, we should consider new partner's share in firm's goodwill. So if it is already giving you new partner share, use it as it is, but if the problem is giving you firm's value, then convert it into new partner share. First method, premium method. First point is method is premium method. Value will be new partner share in the firm's goodwill, and the ratio to be used is sacrifice ratio. Which ratio we are going to use? Sacrifice ratio. How to calculate sacrifice ratio? Sacrifice ratio is equal to old ratio minus new ratio, that is sacrifice ratio. OR minus NR is equal to SR. So I'm repeating again, what is the situation? Goodwill is not appearing in the balance sheet and the new partner is told to bring his share of goodwill in cash. Then such a system or such a method is called as premium method. In this situation, the value of the goodwill will be new partner share in firm's goodwill. The accounting entry will not be passed for the firm's goodwill. Accounting entry will be passed for the share of new partner in firm's goodwill. For passing the accounting entry, we are going to use sacrifice ratio, which is calculated as old ratio minus new ratio, and the entries will be very simple entries. But these are little bit ulta entries. Why they are considered as ulta entries? What is so special about them? Think about a simple situation. We want to sell stock. How do we sell stock? We purchase the stock first and then we sell the stock. So first stock is coming in and then stock is going out. First stock is coming in and then the stock is going out. It means I can specify that when the stock is coming in, the entry is purchase account debit to cash account, or purchase account debit to creditors account. Thereafter, sales entry, cash account debit to sales account, or cash account debit, debtors account debit to sales account. So first we are purchasing, then we are selling. In this case, we are not talking about stock. We are talking about goodwill. If suppose you would have sold furniture, again same situation. You would have purchased furniture first, then you would have sold it. You would have sold planted machinery, same situation. You would have purchased planted machinery, then you would have sold it. So whenever we are selling something, we first of all purchase it and we sell it as it is, or we sell it after using the same. If we are selling it as it is, then it is generally our goods. If we are selling it after using, then generally they are our assets. But whether it is goods or it is assets, by default, first purchase, become the owner, and then sell. But take the case of goodwill, we have already mentioned at the top of this table. Let me use my laser pointer. At the top of the table, we have already mentioned that goodwill is not appearing in the balance sheet. So in the balance sheet, there is no goodwill. And we are telling that new partner is bringing his share of goodwill in cash. So cash is coming in. Why cash is coming in? Because new partner is saying he will be enjoying the benefit of the goodwill of the firm which was generated by the old partners. So first entry is directly cash account debit to what is being sold. Goodwill is being sold. Goodwill is not there in the balance sheet, still we are selling it. So before purchasing it, we are selling it. Furniture we purchased first, then we sold. Stock we purchased first, then we sold. Land and building we purchased first, then we sold it. But for goodwill, we did not purchase it at all. If we would have purchased it, it would have come in the balance sheet. We have not recorded it at all. How did then we sell it? Because for past 10 years, 15 years, our old partners were working hard. With their hard work, dedication and customer satisfaction, they have generated goodwill, but it is a self-generated goodwill, so there is no cost to this goodwill. There is a value to this goodwill, which we have calculated either by average profit method or by super profit method. So first we are saying, new partner, you bring in cash. Why are you bringing cash? Because you are going to enjoy the goodwill which is generated by the old partners. Hard work done by old partners, but benefit is going to be enjoyed by you also. Don't forget to pay for the same. So we are saying cash account debit, and why cash is coming in, goodwill is going out. Actually goodwill is not going out, it is with the firm only, but the benefit of goodwill which was earlier enjoyed by only old partners now will be enjoyed by old partners as well as new partner. That's why we are saying goodwill is shared. Cash account debit to goodwill account. And then we are asking, if you want to sell goodwill, you must have goodwill. If you want to sell goodwill, you must have it first. You must own it first. Then where did it come from? How could you become the owner of the same? How did the firm become the owner of the goodwill? So we are saying firm became owner of the goodwill because of the old partners. So who brought this goodwill in the firm? It was the old partners who worked hard for customer satisfaction and they generated this goodwill. So the goodwill or reputation of this firm was generated, brought in by the old partners. Then we are saying goodwill account debit to old partners capital account. So generally for stock, furniture, land, building, vehicles, etc., first entry is coming in, then the entry is selling out. But in case of goodwill, we have said first entry is sale, cash to goodwill. Cash is coming in, goodwill is going out. But if we are selling it, then we must have received it. From whom did we receive it? We received it from the old partners. So second entry is goodwill account debit to old partners capital account. I hope you have understood the idea. We are selling it first and then we are realizing, arey, we sold something. Where did we get it from? If we are selling it, that means we are the owner. How did the firm become the owner of goodwill? Because the firm got a reputation. Why did a firm get a reputation? Because the old partners worked very hard. It means the real contributors of this goodwill are the old partners. So this goodwill belongs to them. In short, although it appears that the firm has sold goodwill to the new partner, in reality, it is the old partners who have worked hard, have created goodwill, have created reputation, and they are ready to share this goodwill with the new partner. So here you will find that in these two entries, goodwill account is first of all getting credited and then it is getting debited. Credit means going out and debit means coming in. So we are saying that it is going out, and then we are asking if it has gone out, that means it must have come in first. So where did it come in from? It came in from the old partners, because old partners worked for it. If you are a good student of accountancy, you will understand, sir, ultimately goodwill account is getting cancelled, because the entry is cash account debit to goodwill account and goodwill account debit to old partners capital account. So goodwill account is credited, thereafter debited, that means goodwill account is cancelled. Yes, what you are saying is true. In reality, we are saying cash account debit to old partners capital account. That is the ultimate entry, combined entry. But remember, in 12th standard exam, you should not pass combined entry. You should pass two separate entries, cash account debit to goodwill account and goodwill account debit to old partners capital account. Sir, old partners means if there are two old partners, then yes, two old partners. Three, then three old partners. Sir, but then how to divide the amount of goodwill in those two old partners or three old partners? For that purpose, we are going to use sacrifice ratio. How to calculate sacrifice ratio? Previous lecture. Old ratio minus new ratio is equal to sacrifice ratio. So only two entries, cash account debit to goodwill account, because we are selling the goodwill, and this goodwill was generated by the old partner. So entry is goodwill account debit to old partners capital account. So goodwill will get cancelled, cash account will get increased, and old partners capital account will get increased. In which ratio? In their sacrifice ratio. So only two entries are required, no third entry, only two entries. Sometimes the problem may specify goodwill is not appearing in the balance sheet, and new partner is bringing his share of goodwill in cash. But after he is bringing in cash, the old partners are withdrawing the goodwill. So first point same, goodwill is not appearing in balance sheet. Second point same, new partner is bringing his share of goodwill in cash. But third point is different. In the earlier situation, it was assumed by us that it is retained in the business. In the new situation, we are saying that it is withdrawn by the old partners. So the method will be premium method, same. Value will be again new partner share in firm's goodwill. In fact, whenever we are saying premium method, you can straight away give the answer value is new partner share. Premium method means new partner share. Ratio will be again sacrifice ratio. Premium method means sacrifice ratio. No tension. The moment you are saying new partner's share in firm's goodwill, ratio will always be sacrifice ratio. No tension about it. And then the entries will be first entry as usual. We are selling the goodwill. Cash is coming in. Goodwill is going out. Cash account debit to goodwill account. Then we are asking a question to ourselves. If we sold it, we must have owned it. How did we own it? Did we buy it? No. Did we purchase it? No. Still we are owning it. That means somebody must have generated it. Who generated it? Old partners. Okay. So this goodwill had come in the past, but we forgot to record it. Goodwill account debit to old partners capital account, because every year goodwill was getting generated, increased, appreciated, and every year we are keeping mum. So now we are getting some money for it. We are going to transfer it to old partners. Entry will be goodwill account debit to old partners capital account. Be careful, after passing this entry again your goodwill account credit and goodwill account debit means goodwill account is getting cancelled. So ultimate entry is cash account debit to old partners capital account. In which ratio? Sacrifice ratio. But we are not going to pass combined entry. We are going to pass two separate entries, cash to goodwill and goodwill to old partners capital. And thereafter, since the old partners are withdrawing goodwill, we'll pass the entry old partners are the receiver and cash is going out. Entry will be old partners capital account debit to cash account, because old partners are the receiver, debit the receiver, and cash is going out, credit what goes out, so to cash account. Sometimes in examination situation, students get confused. They feel, sir, goodwill is withdrawn, so old partners are the receiver and goodwill is going out. Now be careful. Goodwill is going out means ultimately what is going out? Goodwill is not like stock. Goodwill is not like plant and machinery. In fact, if you have seen it, we have already credited goodwill and then we have debited goodwill. So goodwill account is anyway cancelled. There is no goodwill account in balance sheet now. By the first entry, goodwill account was already credited. And then by the second entry, goodwill account got debited. So goodwill account is already cancelled. So when old partners are withdrawing goodwill, it really means old partners are withdrawing cash which they received under the name of goodwill. I hope you are understanding what I am speaking. When goodwill is withdrawn means ultimately it is cash withdrawn. So, sir, why are they calling it as cash? Goodwill is withdrawn by the partners. They should have simply said old partners withdrew cash. Yes, what you are saying is true. In reality, they could have simply said old partners withdrew cash. But if they are going to say old partners withdrew cash, then you will immediately ask the question, how much cash they are withdrawing? So they are giving you the answer now, that the old partners are withdrawing that much cash which was received by them towards goodwill. So instead of giving a long sentence, old partners withdrew that much cash which is received by them towards goodwill, they are straight away telling you old partners withdrew goodwill. So they are omitting certain words. But we should understand that those are the blank words. Those are the hidden words which we should understand on our own. Old partners are withdrawing goodwill means old partners are withdrawing that much cash which was received by them in goodwill. So the entry is old partners are the receiver and cash is going out. Please remember, I am repeating for the last time, goodwill is withdrawn does not mean goodwill account should be affected. Goodwill is withdrawn means cash is withdrawn. Entry is old partners capital account debit to cash account. How much amount? Whatever is the amount of goodwill withdrawn by the partners, the same should be considered. Sometimes the problem may specify full goodwill is withdrawn. Sometimes the problem may specify half of the goodwill is withdrawn or 60% is withdrawn. So whatever is told by the problem, that much amount we are going to debit to the partners capital account and cash account will be credited. Next situation can be goodwill is not appearing in the balance sheet and it is paid privately. See, what I will recommend is, once you are understanding a particular method, thereafter stop the video, pause the video, write down the part of the table, then you resume the video again. So let me now consider the third situation. Number one, in the balance sheet goodwill is not appearing, and number two, the goodwill is paid privately. Goodwill is paid privately by the partner. If the goodwill amount is paid privately by the partner, it means the amount of cash towards goodwill was not brought in the firm. Firm is not at all involved in this transaction of payment of goodwill. Who generated goodwill? Old partners. For whom? Firm. Firm is admitting new partner. The profit will be enjoyed by new partner also. If new partner, instead of joining the firm, would have started his own business, then the old partners would have got more share in the profit. But because the new partner is admitted, old partners will have to sacrifice some share of their profit. So they are demanding the money for the same. They are saying the goodwill is generated by us. You are going to use it. Don't forget to pay for the same. So this payment can be done through firm or this payment can be done privately. If it is done through firm, in that case the first two methods, either retained in the business or withdrawn by the old partners. Third case, it is paid privately. So the new partner is going to the house of old partners and paying them goodwill directly. He is not coming to the firm. So firm's cash box, no cash is received. Since firm is not involved in this transaction, firm will say no entry in my books. If nothing is coming in, nothing is going out, whatever is happening is in your personal private house. Why should accountant of firm should record that entry? So he'll say sorry, no entry in my books and no effect in my balance sheet. This transaction may be recorded by private accountant of the old partners and the new partners if any, but I am the accountant of partnership firm. So I will not record this transaction because for the firm neither the cash came in nor the cash went out. Neither it has come in nor it has gone out. So for us there is no transaction. For us we are not going to record the entry. We are here to record the transaction in which the firm is involved. When the firm is not involved, sorry, we will not record the transaction. So if goodwill is not appearing in the balance sheet and the adjustment tells you that the new partner paid goodwill privately, then you should be happy because there is no journal entry, no ratio to be calculated, no valuation of goodwill to be done, no need to find out if the firm's goodwill is so and so, the new partner share is so and so, nothing of that sort. This is the simplest method. So if you want to pray to God, I want to have an easy paper, then think that in admission there should be goodwill paid privately because there is no entry, no calculation, nothing of that sort. Goodwill not appearing in balance sheet, but the new partner is bringing his share of goodwill in cash. Then two entries, cash to goodwill, goodwill to old partners in sacrifice ratio. New partner is bringing his share of goodwill in cash and it is withdrawn by the old partners. Then three entries, cash to goodwill, goodwill to old partners in sacrifice ratio and old partners to cash. And if it is paid privately, no entry. Okay. So we have completed the first part, goodwill not appearing in balance sheet but premium method. That is, new partner is bringing his share of goodwill in cash which may be retained in the business or which may be withdrawn from the business. Now let us consider second situation. Here again I am considering goodwill is not appearing in the old balance sheet. Here again I am considering goodwill is not appearing in the old balance sheet. That means problem balance sheet, there is no goodwill. But the new partner is also saying, sorry, I cannot bring in cash. I don't have cash. I can bring in some capital, but I can't bring in cash. So just like the previous problem, goodwill not appearing in the balance sheet, this situation also goodwill not appearing in the balance sheet. But in the previous case, new partner was ready to bring his share of goodwill in cash. In this case, new partner is not having sufficient cash at his home, so he's saying, sorry, I can't bring it in cash. In that case, there are two ways in which old partners can deal with this situation. I'm repeating last time. In the previous case also, problem balance sheet did not have goodwill. In the current case also, problem balance sheet is not having goodwill. But in the previous case, new partner was having sufficient cash at his home, so he was ready to bring his share of goodwill in cash. In this case, new partner probably is a poor partner. He is saying, sorry, I cannot bring my share of goodwill in cash. In that case, the old partners are still having these two different methods. These are dangerous methods because these are going to give trouble to the new partner. But yes, these methods are possible. Why are they going to use it? Reason is simple. Goodwill was generated by the old partners and the benefit of it is going to be enjoyed by the new partner. Something which belongs to the old partners, if it is used by somebody else, then that somebody else must pay for the same. When you use something which is owned by somebody else, Ola, Uber, you are using car of somebody else, you'll have to pay for the same. If you are staying in a rented house, you are using the house owned by somebody else, you'll have to pay for the same. Rent you'll have to pay. Similarly, if you are using goodwill created by somebody else, owned by somebody else, generated by somebody else, you'll have to pay for the same. And you are saying, sorry, I don't have cash. Old partners are not going to forget that. They are going to say, no, we have worked hard, we have created reputation, we want, and this reputation you are going to enjoy along with us. But you are going to enjoy when you don't have the right to enjoy. If you would have worked with us, if you would have generated it, then we could have said, yes, you have a right to enjoy it. But we generated it and you are going to enjoy it. Don't forget to pay for the same. If you are bringing in cash, that's the greatest thing, easiest thing, premium method. New partner is bringing his share of goodwill in cash. If you are not bringing it in cash, in that case we are going to use valuation method. Then there are two different situations. Either it is raised in the books or it is raised and written off in the books of the partnership firm. Both these situations are called as valuation method. In both these situations, we are going to consider firm's goodwill. So simple rule, whenever you are considering premium method, you should consider new partner's share in firm's goodwill. And whenever you are considering valuation method, you should consider total goodwill of the entire firm, not only new partner's share. Ratio will be, when it is premium method, ratio is always sacrifice ratio. When it is premium method, ratio is always sacrifice ratio. When it is valuation method, ratio is not sacrifice ratio, but ratio is old ratio. If it is raised in the books of the firm, then only one ratio, old ratio. If it is raised and written off, that means there are two transactions. In that case, for raising, we will use old ratio, and for writing it off, we are going to use new ratio. So here we are not using sacrifice ratio. We are using old ratio or old ratio along with new ratio, but we are not using sacrifice ratio. So premium method, always sacrifice ratio. And valuation method, either only old ratio or old ratio along with new ratio. Hope you have understood the idea. Now if you are thinking of raising in the books of the firm, what is the entry? Entry will be goodwill account debit. No cash is coming in, so cash account cannot be debited. New partner does not bring his share of goodwill in cash. So then on the asset side, we are generating, we are rising, we are writing, we are creating goodwill account. That goodwill account will start appearing now. In the old balance sheet, it was not there. In the problem balance sheet, it was not there. But in solution balance sheet, it will appear. So goodwill account will get debited. Goodwill account debit. To what? To old partners capital account. Because this goodwill was generated by old partners. But which value? it is not new partner share, it is the entire goodwill of the firm's goodwill. Goodwill account debit to old partner's capital account, only one entry, no second entry, so that second entry part or that place is empty. After passing this entry, goodwill account will get created. It will have a debit balance, so it will come on balance sheet asset side, and on the liability side, old partner's capital account will get credited by the value of firm's goodwill, not only new partner share but firm's goodwill, and old partner's capital account will get credited by old ratio, not the sacrifice ratio. Then comes the second situation. Same point, goodwill is not appearing in the problem wala balance sheet, but it is mentioned that new partner does not bring his share of goodwill in cash. Instead, it is decided that goodwill will be raised and written off. Goodwill will be raised and written off. In such a situation, we'll specify for raising, let us use old ratio. For writing off, let us use new ratio. There are two transactions. Let us pass the entry. Goodwill is raised in our balance sheet. Goodwill account will come. Goodwill account debit. And it is brought in by whom? By the old partner. So it will be credited to old partner's capital account. Goodwill account debit to old partner's capital account. In which ratio? In the old ratio. And immediately we are writing it off. In that case, the entry will be goodwill account will have to be credited because we want to write it off. In the first entry we debited it, we created it. Now you want to write it off, you want to cancel it, so it will be credited, and debit will be given to whom? Now here you will have to be careful. Debit will be given to all partners. Credit was given to old partners, debit is given to all partners. Since it was old partners, it was old ratio. Since this is all partners, this is going to be new ratio. Entry will be all partners capital account debit to goodwill account. So the idea is, if the new partner is bringing his share of goodwill in cash, we are happy. We are saying bring in cash and we will transfer it to old partners. If you are not bringing it in cash, then we'll record it in our books. It is as good as asset revalued. This asset of goodwill, which is having a zero value in the existing balance sheet, is required to be increased. That's what we are doing. So we are transferring it to old partners capital account in their old ratio. And if you want to write it off, then immediately we are going to say all partners capital account debit to goodwill account. So that is how we are going to adjust the situation. In the first case, goodwill account will appear in the balance sheet. In the second case, goodwill account will not appear in balance sheet. But old partners capital account will first get increased in old ratio by the full value of firm's goodwill. Then all partners capital account will get decreased in new ratio. So if you apply your mind, then you can understand that old partners capital account increased first by old ratio, then decreased again by new ratio. So old ratio minus new ratio, that means it is sacrifice ratio. Ultimately it is going to come to the same situation. But in 12th standard, no need to consider too much about it. Just remember, first entry, goodwill account debit to old partners capital account in old ratio, and all partners capital account debit to goodwill account in new ratio. But these two entries to be passed only if it is clearly mentioned that goodwill is raised and the partners decided to write it off. If the partners have not decided to write it off, if there is no adjustment about writing it off, then we can follow this method only for an entry, goodwill account debit to old partners capital account. Okay, so we have completed two different situations or two different parts. Goodwill not appearing in balance sheet is the main heading, in which either new partner is bringing his share of goodwill in cash, or new partner is not bringing his share of goodwill in cash, but it is either raised in the books of the firm or it is raised and written off in the books of the firm. And last case, goodwill is already appearing in the old balance sheet. Now the problem balance sheet is already having goodwill. Problem balance sheet is already having goodwill, plus the new partner is bringing his share of goodwill in cash. Now what is the meaning of problem balance sheet already having goodwill? It means in the past they have already passed the entry for raising the goodwill. Maybe A and B were two partners. Then they admitted C. C was not having capacity to bring in goodwill at the time of his admission. So they raised the goodwill. At that time it was not written off. So goodwill is there in the balance sheet. And now they are admitting D. So at the time of admission of D, the balance sheet is not of A and B, but balance sheet will be of A, B and C. And at the time of C's admission, goodwill account was created. So goodwill is already appearing in balance sheet. Or maybe the balance sheet is of A and B. A and B have not started the business on their own, but earlier it was done by Mr. X, whose business was purchased by A and B. So they were required to pay to Mr. X some amount of goodwill. that goodwill is appearing in the balance sheet of A and B. That is also possible. So goodwill is already appearing in whole balance sheet. There are various reasons why goodwill may appear in the balance sheet of the problem. But if it is there and plus the adjustment is telling you that new partner is bringing his share of goodwill in cash, that means again it is a premium method, because whenever cash is coming in towards goodwill, it is called as premium method. But in that case, remember value. How should we consider value? For the amount of goodwill brought in by the new partner, we should consider new partner's share in firm's goodwill, not the full goodwill of the firm. And for the old goodwill, we should consider firm's goodwill, the existing goodwill, that whatever value is given, that we can take it as it is. Ratio will be, for that brought in ka entry, the entry of brought in, we should consider sacrifice ratio. And for the old goodwill treatment, we should consider old ratio. Now we should not consider new ratio, we should consider old ratio. So when goodwill is already appearing in the old balance sheet plus new partner is bringing his share of goodwill in cash, then for bringing in cash it will be counted as new partner share, and old goodwill obviously it is firm's goodwill. For bringing in cash to record, we are going to use sacrifice ratio, and for existing goodwill we are going to go for old ratio. Now the rule says that if there is existing goodwill in the partnership firm balance sheet and the new partner is bringing in his share of goodwill in cash, then it is better to write off. The existing goodwill. So write off. We have just now understood. Write off means new ratio. Yes. But write off means new ratio when goodwill is not appearing in the old balance sheet and the partners have decided to raise the goodwill and write it off. Then we are going to say written off is equal to new ratio. In our case, we are saying goodwill is already appearing in balance sheet. Further, new partner is bringing his share of goodwill in cash. So in that case, for existing goodwill write off, we are going to use old ratio, not the new ratio. So there will be two entries. There will be three entries. First entry, cash account to goodwill account. This is for the purpose of the premium method. That is the new partner share which he has brought in cash. Cash account to goodwill account. Second entry, if we have sold it, that means we must have raised it. We must have generated it. Who generated it? Old partners. So let us transfer it to old partners capital account. Entry will be goodwill account debit to old partners capital account in sacrifice ratio. These two entries are exactly same like that of our second situation. If you remember here, cash account to goodwill, goodwill account to old partners, in which ratio? Sacrifice ratio. Same thing is done by me. Cash to goodwill, goodwill to old partners capital, sacrifice ratio. But third entry extra, that existing goodwill, firm's goodwill, that will have to be written off. And remember, we are not going to use new ratio, but we are going to use old ratio. Entry will be old partners capital, not all partners capital. Old partners capital. Repeating for the last time, old partners capital account debit to goodwill account. So goodwill written off can be dealt with in two ways. If goodwill is not appearing in balance sheet, it is raised and written off. In such case, for raising old ratio and for writing off new ratio. If goodwill is already appearing in balance sheet and new partner brings his share of goodwill in cash, then there is no need to raise the goodwill. Then you are just going to write off the goodwill. So it will be old partners capital account debit to goodwill account. I hope you have understood the case. It is old goodwill to be written off. Entries, old goodwill is fully depreciated like a revaluation loss. So it will ultimately go to old partners capital account debit side, and goodwill account is required to be reduced to 0. So to goodwill account. And cash is coming in because new partner is bringing his share of goodwill in cash. So entry will be cash to goodwill and goodwill to old partners capital. In which ratio? Obviously sacrifice ratio. This is the simple point of premium method. Now last case, goodwill is already appearing in the balance sheet. New partner does not bring his share of goodwill in cash. If goodwill is already appearing in the balance sheet, that means there is some value. New partner is not bringing his share of goodwill in cash. That means either it can be raised now or it can be raised and written off now. Some such adjustment may come, but the problem is telling no, neither there is an adjustment of raising nor there is an adjustment of writing it off, but there is an adjustment of revaluation of goodwill. So in the problem balance sheet, goodwill is appearing at say rupees 5,000 and there is an adjustment in the problem which tells you that goodwill is revalued at rupees 6,000. So 5000 is there and it will be made to be 6000. Then what is to be done? We'll say this is called as again valuation method. Value should be firm's goodwill, ratio should be old ratio, and entry will be goodwill account debit to revaluation account. Or you can also pass the entry, depends upon you. You can also pass the entry goodwill account debit to old partner's capital account or old partner's current account. In which ratio? Old ratio. I'm repeating again, entry will be only one single entry, only one entry. What is the entry? Goodwill account debit. To what? Either you can say to revaluation account or you can say to old partner's capital or old partner's current account. Only one entry. So no second entry, no third entry. After passing this entry, obviously goodwill account will not get disappeared. It will now appear in the balance sheet, not at 5000, but it will appear in the balance sheet at 6000. And old partner's capital account will get increased by that amount of appreciation in that old ratio. Okay. So what I'll recommend you is, after completing each and every single column of different methods, please pause the video, write down the part of table, try to revise it properly. If you are finding it difficult, again rewind the video, go back, listen to my lecture. Then once you are clear with this entire concept, then go for the next column. That is how you are going to complete the thing. So I have taught you basically two different situations. First situation is goodwill not appearing in balance sheet, in which there are again two subparts. Either new partner is bringing his share of goodwill in cash or is not bringing it in cash. If he is bringing it in cash, it is premium method, ratio is sacrifice ratio. If they are retaining it, only 2 entries. If they are withdrawing it, 3 entries. Cash to goodwill, goodwill to old partners, or cash to goodwill, goodwill to old partners, and old partners to cash. Bas, kam khatam. Ratio will be sacrifice ratio. And if again old balance sheet, no goodwill, but new partner says sorry, I cannot bring in cash, then the partners may either decide to raise the goodwill or they may decide to raise and write it off. If they are raising it, only one entry, goodwill to old partners in old ratio. If they are raising and writing it off, then 2 entries, goodwill to old partners capital, and then all partners capital to goodwill, goodwill to old partners in old ratio, all partners to goodwill in new ratio. And goodwill appearing in the old balance sheet, then there are two situations again possible. New partner is bringing his share of goodwill in cash, or new partner is not bringing in cash, but there is some revaluation adjustment. So if he is bringing it in cash, then old goodwill should be written off to the old partner's capital account in old ratio. And for new goodwill brought in cash, simple entries of bringing in cash, premium method, cash account debit to goodwill in and goodwill account debit to old partner's capital in sacrifice ratio. If it is there in the old balance sheet, problem balance sheet, and new partner is not bringing it in cash, but there is some adjustment of revaluation, then you have to pass the entry of the amount of revaluation, old balance sheet का value and adjustment का value, दोनों के बीच का difference, balance sheet मधली value आणि adjustment मधली value या दोघांमधला difference calculate करायचा, difference entry पास करायची. entry काय पास करणार? goodwill account debit to revaluation account or goodwill account debit to old partners capital or current account, in which ratio? In old ratio. Simple. Okay, so that's all I wanted to discuss about goodwill. I have discussed in detail 3 different lectures. Almost each lecture is of 1 hour. First one, what is the value of goodwill? How to calculate value of goodwill? Second one, what are the ratios? And third one, now how to pass the entries. Please go through these lectures again and again. If you find it boring, no problem. Skip the lecture. Directly go for solving the problems with me. After solving the problem, then you will start understanding how the beauty of these entries ultimately decorate our problem or decorate our balance sheet or tally our balance sheet systematically. Then you can understand it again. So these first 4 lectures you can go on revisiting again and again. As many times you are going to see these lectures, you will find it easy to understand. Solve a problem, again go back to these lectures. Solve a problem, again go back to these lectures. The more you are going to understand first 4 lectures, it is going to be easy for you to solve the problems afterwards, any type of problem. Okay, so from next lecture we are going to start solving the problem. Keep your notebook ready and textbook ready, pen, pencil, scale for the purpose of drawing, etc. And then we are going to solve the problem. Okay, one problem, one lecture. That's what I'm thinking. So I'm considering again 13-14 more lectures, one lecture for one problem at a time. Okay, thank you very much. So in the next lecture we are going to meet for solving the problem. Bye bye.